Imagine this. At the core of our global financial system, there exists a group of powerful institutions known as central banks. They wield immense influence by issuing legal tender money, stabilizing payment systems, and anchoring trust in every modern economy. We often talk about the markets as if they operate independently, but their foundation lies in these central banks. Institutions like the Federal Reserve, the European Central Bank, the People's Bank of China, and the Bank of Japan form this elite group. Their core mandate is price stability and, in many cases, maximum sustainable employment. To achieve these goals, central banks utilize three primary tools. First, the policy rate. This is the interest rate they charge or pay on the reserves commercial banks keep at the central bank. By adjusting this rate, they can influence borrowing costs across the economy. Second, open market operations involve buying or selling government securities to manage liquidity. And third, reserve requirements determine how much cash banks must hold rather than lend. These tools, while simple in principle, are incredibly powerful when used together. But central banks are more than just policy tools. They also act as the ultimate safety net for commercial banks. When liquidity dries up, like during the 2008 financial crisis or the pandemic shock of 2020, central banks step in. They expand their balance sheets, accept a wider range of collateral, and provide funding to ensure that solvent institutions survive. Without this support, the entire payment system could seize up, bringing commerce to a halt. Central banks also coordinate on a global scale through the Bank for International Settlements in Basel. This coordination was crucial during the COVID-19 pandemic when the Federal Reserve opened dollar swap lines with 14 foreign central banks within days. This prevented a scramble for dollars that could have crippled global trade. It's a clear example of the peer-to-peer diplomacy embedded in the system. Each sovereign guards its autonomy, but also recognizes their interdependence. Modern central banking toolkits have evolved. Quantitative easing and forward guidance have become standard practices, and central banks are now experimenting with digital currencies. The Riksbank in Sweden is piloting an e-krona, while the PBoC in China rolls out the e-CNY. And these digital currencies could one day transform how central banks interact with the commercial banking sector. Despite their power, central banks operate within a framework of independence and accountability. Legislatures define their mandates, appoint governors, and can rewrite their charters. This balance ensures that while central banks can fight inflation, even when governments prefer cheap money, they remain accountable to democratic principles. Monetary sovereigns also play a crucial role in bank supervision, determining capital requirements and overseeing mergers and acquisitions through stress tests and inspections. Their influence extends into cross-border payments, with systems like Fedwire, CHIPS, and Target 2 facilitating the flow of money across borders. This influence can also be geopolitical, as seen when Russian banks were cut off from SWIFT messaging in 2022. In conclusion, understanding the role of monetary sovereigns is essential for anyone involved in finance. They manufacture, base money, support the banking system, and coordinate global financial stability. By anticipating their actions, you can better navigate the financial landscape and make informed decisions. So keep an eye on the deliberations of these central banks. They are the invisible architects shaping our financial world. Stay informed, stay ahead, and see you in the next video.